Hey everybody, welcome to the No Shill Zone. How you doing, Ben? I was just talking to you there. We had a good discussion going on. How you doing today?
Pretty good. Now we can actually bring up some charts to sort of support the discussion.
Yeah, just to let everyone know, we were just on a Spaces and we were going back and forth and talking charts and alpha and data, and it's always fun to get the discussions going. So it was kind of, I look at it like a warm up. Right now we're warm, we're ready to go. Now we're going to deliver to you guys all the good stuff here. As we get into it, right? So we've seen Bitcoin fall, beautiful little drop. We're actually breaking the 29,000 level as we speak. Take a look at this, guys. Now, one thing I've talked about, and I'll throw it to you in a second, Ben, is that we've talked about how this channel was insanely hard to break out of. And again, a lot of people don't understand why it's such big resistance. And I want to just show you here, folks. If you go back to the beginning of the bull market, right? So we were already trading up here, and we had this big move to about the 42,000 level, and we retraced right there, and it stalled, and then it rallied to 65,000. Then we came down 3 full times, 1, 2, 3, and we rallied to 69,000. And then we kind of came down, eventually consolidating right here and breaking down. And that's why this level is such a major technical resistance, because that was the buyer level back then. That was where everyone bought. So once we broke, it's now where everyone that bought in here is actually selling, right? They're like, oh my goodness, I got back to break even. I'm going to unload. In addition, it also has the aspect of being a technical level that I see. And so I've shorted multiple times into this level, as I'm sure many hundreds, if not thousands, of other technical traders have. So here we are breaking down, trading right around 29,000. And you could see how we kept on getting rejected. Even when closing above, you had a reversal candle. This is a topping tail. So topping tails are powerful. This was a green candle. This is called a reversal candle in technical analysis. And then we were hugging this lower level and finally the break point. So I wouldn't say that we're definitely heading straight down, but I think Ben and I would both agree that there's probably some weakness in Bitcoin coming in. We were just talking about it on the Spaces, Ben.
Gareth, I have a question. You said something that kind of caught my interest. So in the bull market, we tested this level a few times, and then we put in a higher high, right? What do you think about testing it now, but putting in a lower low, kind of sort of the opposite of what we did in the bull market? Do you think that's a possibility?
I do. And again, we were talking about it on the Space a little bit, but just in terms of the market coming down and potentially making a lower low down here, to me, it's honestly, I've become more convinced that that's going to happen based on what's been happening in the stock market relative to Bitcoin. And I think you put it perfectly, is that altcoin money has really been what's been propping Bitcoin up, right? Bitcoin alts are going lower. Bitcoin has been the recipient of a lot of that money, and it's been grinding higher. You haven't really seen the NASDAQ's been making insane moves to the upside. NVIDIA stock, I mean, take a look at this chart on NVIDIA here. This incredible move, right? We made huge new all-time highs on NVIDIA. Now, granted, it was the AI story, but it was drawing liquidity away, but there was no recipient. You didn't see Bitcoin breaking out when NVIDIA had this move to the upside. So that's a concern. And the concern becomes that if the stock market, let's just say we pull back to this gap fill on a technical basis, this is probably where we're headed back to on NVIDIA. So if we drop, that would be about 30% on NVIDIA. Where is Bitcoin at that point? Where is the altcoin market? And I would be scared to think about where the altcoin market is at that point. So I do think that if the stock market is to drop 10, 15, 20% from where it is, it's hard to believe that Bitcoin, if Bitcoin fell, so let's do this and think about this, right? So Bitcoin was at 69 and the stock market was at all-time highs. Bitcoin dropped to 15.7, then bounced 100%. The NASDAQ has rallied massively, right? And so if we fall, let's just say we fall back to these October lows on the NASDAQ, to me, why wouldn't Bitcoin be below 15.7 when it only has to drop about $13,000, $14,000 versus dropping from 69 to 15 the last time we dipped down to these lows? Does that make sense?
Yeah, I mean, for sure. Like if one sector gets hit pretty hard, you would expect the higher risk sector to get hit even harder, right? It was actually, it's funny because again, we talked about this as well. And if the S&P does, well, when the S&P gets a 5 to 10% correction, right? Like it'll happen at some point. We don't know when it's going to be. that's normally what stops the rally in crypto in the pre-halving year. And I mean, like you can see it over here when we got pullbacks in the S&P 500 back in about this time of again the pre-election year last cycle. We saw Bitcoin fade. What's interesting, Gareth, is as you know, I've been talking about the altcoin reckoning for a while, and I know you have too. The idea that alts just kind of bleed. They bleed on their Bitcoin pairs. They bleed on their USD pairs. There's this idea as well that it might not seem like it, but it is still tracking the .com crash, right? So look at the Nasdaq in the .com crash, and look at this double top here on the Nasdaq. It then went lower, put in a higher low, and then got rejected here off of that 20-week SMA. This looks identical to what is happening now with the altcoin market, right? You go above it, you put in sort of a double top, then you put in a higher low, only to potentially get rejected here. And I think this is where the concern could come in is, well, what happens if the altcoin market just sells off for the next 30 weeks or so? So it would be in that type of environment where there's no longer sufficient liquidity in the altcoin market to prop up the price of Bitcoin, right? And that's how you see Bitcoin go down, but the altcoin market still, the dominance of Bitcoin still goes up just because the altcoin market is going down even more. And by the way, if the altcoin market were to bleed as much as the NASDAQ did from this point, it would still be about another 50% drop, you know? Yeah. So that I think is the issue with the altcoin market is, you know, we haven't really deviated from the .com crash. And you could even pull up, say, like the 50-week. I mean, look at where the NASDAQ got rejected off of this double top. It was right at the 50-week moving average. And if we care to guess where the 50-week is right now, that is exactly where the altcoin market here is potentially getting rejected. So I think that liquidity is drying up. I think it's certainly hitting altcoins before it hits equities, right? And we know that equities love climbing the wall of worry until the unemployment rate goes up. But I think crypto is going to get hit first.
Yeah, and I agree. And I think one of the couple things that I want to just bring up is number one is that the .com situation is what I've talked about for the last year plus 2 years, in that you have all these crappy, I mean, living through and trading through the .coms, there was pet.com, there was, you know, I make you a dinner.com. I mean, like every crappy idea was thrown out there and they attached a .com to it, and it got a ridiculous valuation. People would buy it. I mean, it could literally be like, hey, here's my dog's turd.com, and people were like, oh, $100 million valuation, just like that. And the idea here is, if you look at the comparisons of what we've seen in the crypto markets with these shit coins and these meme coins, it's so eerily similar. And what we know from the .coms is that you had to have a washout where, I mean, think about how many .coms, when you came in 2001, 2002, out of that period, how many .coms were really left at that point? I mean, at least the name brand ones, there was maybe 10, maybe 15, maybe 20. Well, very similar. You would probably expect the same thing with the altcoins, right? So there will be some that survive. I think you'd agree with that, Ben, but it will be way less than you have out there. And by the way, if you look at the NFT market right now, I mean, talk about a market that hasn't even bounced yet. I mean, that hasn't even had a slight bounce.
You know, I was looking at something. I just want to follow this up because you mentioned the NFT market, and I was looking at some interesting stuff. So you know how we've tracked the social metrics for some of the different cryptocurrency stuff. There's this social metric I have for Reddit NFT posts. So basically, post on NFT subreddits, right? And look, I mean, just look at it, right? You can clearly see like where the bubble is, and if you zoom in here, I mean, it's actually falling off a cliff right now. Now, and you can look at the same thing as, you know, in comments as well. I mean, like they peaked out sometime early 2022, and it's just been nothing ever since. So again, like I think you're right. I think that most altcoins will just sort of dwindle away, but there's going to be a few that survive, right? There will be a few that survive. So like if you have an altcoin, if someone's out there and they think they found the perfect altcoin and they see it start to get pulled back down, it could be that it's just a function. It's because it's exposed to the market risk, right? It doesn't mean that project won't eventually do well. It's just, hey guys, like liquidity is being sucked up. This just leads to opportunity, if anything, for you, right? It just leads to opportunity. Like you could view it as a glass half full approach if you want to.
Yeah, absolutely. And I think it's important to just take a look at this chart too, which is Fed balance sheet, right? So you had the pop in the Fed balance sheet when the financial crisis, the banks crisis. But if you look here, right, we're now making new lows. And so I think you talked about it. We've talked about it almost in every no shill zone for the last maybe 3 or 4 weeks. But there's the jaws opening up, right, where you have less and less liquidity in the system, but the stock market has continued higher. And the reason that impacts crypto is because it's all liquidity, right? It doesn't matter if it's a stock, if it's a commodity, or if it's a crypto. It all has to do with how much money is in the system. How much money do people have to actually buy things with?
Well, it's also, I think it's interesting too, because with regards to the stock market, you're right. Like the jaws have opened up, as we can see. The jaws have opened up before. Historically, they eventually clamp shut, whether it takes 6 months, whether it takes 12 months, they historically clamp shut. But what's more interesting is that the jaws on the altcoin market, they haven't opened up, right, at all. Mm-hmm. And I think it's fascinating because I think these different asset classes give us different insight into what's going on. Like if you only looked at equities, you might think that there's, the Fed's having no impact on anything, right? Because the equity market has just been going up. If you look at some of the riskier assets like altcoins, they're tracking net liquidity almost perfectly. Right. I mean, this has just been a perfect track here. And again, we're seeing altcoins sell off today, and we're seeing net liquidity down this week, So I think that it shows us what is likely going to come in equities. But for equities, it could be late this year, it could be early next year. I think it's just too hard to know exactly when the unemployment rate is going to finally make that move.
Yeah, and I agree with you that I think we've seen the economic data again in the past week since our last stream. We saw other economic data. I think productivity might have been one that was down, that missed expectations. There's been a bunch. We got some European data out, I think in the last 24 hours that was just horrendous. So at some point the labor market will crack, but I think that's been, if you look at a dam and that's the one thing plugging the dam from breaking and flooding the whole scenario here. So I think it's super interesting. And I do want to mention, and Ben, I feel like this is something we almost have to have at the bottom of our screen when we do these, is that we're both very bullish longer term, but we just try to keep it real, right? I'm not going to come on here, and Ben's not going to come on here and be like, hey guys, to the moon with Bitcoin and everything like that. We want to make sure that people get on the right side of the trade, or at least have a good indication about the likely probability of a move. And that's really what it is. So we are both bullish longer term, especially on Bitcoin, but we want you guys to at least be understanding of what the data is showing us.
And what the data has shown for Bitcoin historically is that it's around that June, July timeframe when it rolls back over. And I'm curious if it has to do with the fact that it's like a pre-halving year, the pre-halving year. I'm curious if it's more so to do with the fact that it's like a pre-election year. But regardless, I mean, in all cases, even in 2011, when we had a more parabolic rally, this is around the time when Bitcoin rolled over. Now, I mean, look, that's not to say that you can't spike up and put in a higher high. I mean, there's always a chance that happens, but this is normally what we've historically seen. And it's interesting because one of the things I've looked at before is sort of averaging out the last 2 pre-halving years for Bitcoin. Because if you average out the last 2 bear markets, it follows. I mean, look how perfectly 2023 is still following the average of sort of the last 2 pre-halving years. So if it wants to follow that, then it would still mean there's still, this level right here, by the way, if we were to go down to this level, it would still correspond to around $23,000. And then perhaps we end up getting a recession sometime late this year, early next year, where we get that final scare right before the real move back up to the upside. Yeah. I'm curious, Gareth. I was just going to say one thing. Like I noticed because we talked about the unemployment rate. We've also talked about inflation as being some of the issues that we could see, the Fed face with. What's your view here? I mean, oil's back up to 78. Are you following oil here at all?
I am actually. And oil actually just had a breakout. Let me just share the right screen here and show it. But this is an interesting one because I think in the near term, it puts us in a situation where we might see oil, and I'm going to bring up oil here now, break out to the upside. But I think once the labor market does crack, that's where you could see oil coming back in. But here's the chart that I've been watching, right? So we've had this kind of lower channel, right? The yellow line down here, the yellow line up here. We've had this upsloping, which kind of creates a wedge pattern. And we did push up. We tagged this level here at $77. And the reason why that was so important was that's basically connecting all the highs going back to 2022 of August, right? So about basically a year ago, connecting those highs, and it coincided with this high. What we then did, and this is very normal in charts, we pulled back to the scene of the crime. And I refer to that, that's a term I use, that basically means that the crime was committed when you broke out, right? You broke out of jail or you broke out of resistance, and then you return to the jail just to see, hey, I was able to do it, cool. And then you break and you finally move above it here. So this is a short-term breakout. I think upside in oil could take us to $83 or so. That's going to be a huge level of resistance right in this vicinity. And you can see this high here with these highs as well, right? So if we just put a line right in this area, that means, you know, with all those highs there, it's going to tell you there's a local area of major resistance. So at least in the short term, I think oil's going up. I do think that whenever the labor market crashes late this year or next year, I do think oil has a big down move, but short term, this is going up. And by the way, this brings us to another point, Ben, is that if oil is starting to gain, and look at where we were at the beginning of July, okay?
Right.
So we were at $69, we'll call it. We're now at almost 79. If we go to the gasoline chart, and by the way, I'm bringing up gasoline because it's also part of the core CPI, a huge part of the core CPI. Look at this, guys. Gasoline is now at basically a 52-week high. Okay, so the reason this is important is because everyone got so excited about CPI dropping year over year and month over month in the last CPI data 2 weeks ago. Well, guess what? Just look in the last month at gasoline, at oil. Gasoline is at 52-week highs, essentially. That's going to make it very hard for CPI to continue to drop below 3% when you have core pushing these highs. And so people just have to have measured expectations, which is the data is showing us right now that sure, we could inch down a little bit more because of other things. And again, we'll have to look at other things out there. But a lot of the core CPI is starting to flatten out or even starting to rise.
Yeah, I mean the base effects too. Like if you gasoline, since you have the chart up, where was it July of 2022?
July of 2022, right here.
Yeah, so I mean, you can see that was coming off of that peak, right? So the base effects are going to get worse. I mean, and look at oil, right? I mean, it sort of topped out in June of 2022. So what once was a favorable sort of headwind for CPI could in fact now become a tailwind going forward to that. And I guess the question is well, how does that affect the Fed's reaction function for going into the end of the year? Are they forced to continue to raise because inflation starts to go back up to the upside? Because again, it's sort of one of two things. You could get the labor market to move, but what happens if you get the reacceleration of inflation back up to the upside? Not that it would be long-lived. I mean, I think eventually we go back into a period of more sustained disinflation, but in the short term, I do think that is a risk that we have to consider.
Yeah, and I think that's something that the market is not discounting. The market, again, continues to live in this happy, and I'm speaking more about the stock market versus crypto, but it's in this very happy place where everything is going to work out perfectly. We're going to have this amazingly soft landing. I think people are lulled into this false sense because of the labor market, because of inflation's dropping. But you get in a scenario where, let's say, even inflation just stops going down. Let's just say it stays at 3%. 3% doesn't sound like a lot, but we know it's above the comfort zone for the Fed. And if that's the case, it's going to mean that when we do see a dump in the economy, when the jobs do start to be lost and we see the jobs market declining, that's going to make it very hard for the Fed to stimulate, right? And it's not to say they can't pause. Maybe they'll pause and just say, okay, we're not going to do anything. But the market is hoping, and they've already priced in, I think, a March 2024 first rate cut. And if inflation's 3% or north, can they really cut? I don't know. That's what we're going to have to find out.
It's one of the questions that someone sort of posed on that Twitter Spaces we were on earlier, and I'd like for us to discuss it here. Is a recession priced in? I mean, history shows us that recessions are not normally priced in until the labor market actually starts to move higher. So, do you think there's a world that we can live in where the labor market, the unemployment rate goes to 5 or 6%, but equities don't get hit?
Not without the Fed printing. I can't see it. Yeah. For me, at least, it's all tied to that liquidity in the system. Like, I mean, if the government were to send out thousands of dollars in checks like they did during COVID for people, then yeah, I mean, if you had those scenarios with the Fed loosening, loosening liquidity and everything, I do think that people would say, hey, listen, I'm going to throw the money in the market. But I can't imagine that being the scenario we're going to be in.
I was looking at something earlier. I think it's kind of interesting. It really shows like how human emotions are. Look at
Yeah.
Google Trends. I
Well,
tweeted at this.
you tweeted this, and I made a mental note to have you bring this up, and you did. Awesome,
Well,
fantastic.
it's interesting because it's kind of like you get an inverted yield curve, and then it's like we know that means, at least history would show, like most every single time, maybe not every time, but most of the time, we get a recession, right? When you get an inverted yield curve. But normally, I think the patient investor has to remember that just because you get an inverted yield curve, it does not mean recession now, right? It means like recession sometime in the nebulous future, typically upon the uninversion of it. So it's kind of funny because you get sort of a people flocking to search this recession term, and then it kind of goes away for a while, and people start to talk about like a soft landing or a no landing, right?
Right.
Or rocket emojis, and then you actually go back up, and I think that's sort of where the real recession is, right? So you get sort of the inverted yield curve where people think it's a recession now, get lulled into a false sense of security when that recession doesn't actually materialize. And then the recession comes just as people think that all is in the clear. We even saw the same thing in 2019. Again, I'm not trying to say that the inverted yield curve predicted the pandemic. I don't think it did, but it did predict that the economy was sick and that it only took one more significant event to push us into a recession. And now we're kind of seeing the same thing, right? We have all these searches for recession right around the time that, the 2-year inverted the 10-year. And now, is this just lulling people into a false sense of security again before it gets another spike, maybe early 2024? What do you think?
Yeah. And I think that's such a great chart. I mean, it speaks 1,000 words. So I think the key is that this is how humans behave, right? We hear about something because something happens, and we react, right? We're emotional creatures. We react right away and say, "Oh my God, I got to get out of the market. This is telling me a recession's coming," and we all panic. And then after a little while, cooler heads prevail, and then things don't look as bad. The world's not ending. And we're like, "Oh crap, we made a mistake," and we all pile back into the market, not understanding the lag effect. And this has been something like, there's so many. I mean, to be honest, I'm bearish on the stock market, as many people know. And one of the keys that everyone is mistaking here is that they think because the Fed has raised and it might be pausing, that the effects are already in the system, already in the economy. And that's not the case. If you look historically, there's a 12-ish month lag in hikes before it's fully felt in the system. And we aren't, I mean, if you look back 12 months ago, where were we in terms of interest rates? A lot lower. And so you have to be aware that that's going to all play out and come through.
I mean, and look, I think the hard thing with stock market is just knowing when it stops climbing the wall of worry. I mean, if you look back, this is the ROI to low after the 3-month inverts the 10-year. And normally we climb the wall of worry, right? That's what it does. The market, we know the market does not need a reason to go up, right? It needs a reason to go down. It likes climbing the wall of worry. But when you get these inverted yield curves, you'll see where we climb the wall of worry quite frequently. Then at some point we eventually roll over. Here in 1989, you can see we kind of came to these similar levels. It took even longer to get to those levels, right? 417 days in. Right now we're only 270 days in or so. But eventually what happened is that we went to a lower valuation on the S&P than where we were when the yield curve inverted. And I think that's the important thing is, the 2-year inverted the 10-year, or actually just going back to the 3-month, right? The 3-month inverted the 10-year, I believe around October. And that was pretty close to the actual low. In all of these prior cases, the S&P eventually took out that low, right? Eventually. Now, did it happen a year from now, or did it happen a year after, 2 years, 3 years? It's hard to say, but in all prior cases, it did eventually happen. And what's interesting is so far out of all of these, the one we're tracking the closest is actually the financial crisis. Not only on the 3-month 10-year inversion, but also on the 2-year 10-year inversion as well. So I think it's worthwhile to continue tracking that just to see if, look at this, just look at how far we climbed the wall of worry from that inversion. You can see back in the financial crisis, we went to about 20% above where the S&P was when the 2-year inverted the 10-year. And we're almost there. We have a little bit further to go to hit that point. But that was where the financial crisis ultimately topped out.
Yeah, and I mean, I think the key is you can understand why it would mirror the financial crisis in that look at what interest rates have done, and even just with what they did to those regional banks. I mean, then you throw in the commercial real estate issues, and I know everyone remains so bullish on residential real estate, but I'm in the opposite camp here. I think that there's this false sense of security because there's not a lot of supply on the market. But if you get any sort of situation with interest rates on the 30-year where people are taking mortgages and paying 7% with prices of homes where they are, and I think there was a stat on this. I saw a chart on this too. I don't remember who posted it, but how expensive, how much income, I think it's 40% of someone's income is now going towards, on average, towards housing, whether it's renting or owning. And that is the highest historically that it has ever been. And think about that, folks. Think about it. 40% of your income is going to housing. And let's say one person in a household loses a job. What's going to happen? You're going to see a massive spike on mortgage defaults. And in fact, I think this was another chart I saw as well, is that it was talking about delinquencies. And I think we are even above 2009 levels on delinquencies. Now, again, I don't want to be all doom and gloom here, but I do want to just kind of counteract the mainstream medias and really even, you know, a lot of players out there that are analysts in terms of saying that everything is perfect, no problems, we're going to have a perfectly soft landing. I do want to give a different perspective so that people can make an informed decision.
I mean, I think that's completely fair. And I think a lot of people appreciate that view because I think, especially in crypto, it's hard to find sort of rational, reasonable views that are sort of based in data as opposed to other things. I'm curious, like, we don't know. I mean, it's impossible to know exactly where the S&P tops out. It could have already topped out. Maybe it gets another leg higher. But I am curious, like, assuming a recession does come for, you know, for us and the S&P gets hit, where do you think, and you can get to this, I know you have another chart up, but where do you think it actually could bottom out? Like, does it have a chance of putting in a double bottom at 35? Could it go to 34? Where does it go?
Yeah, let's definitely go take a look at that, because this is the kicker, is that it really depends on how bad things get. And to be honest, I'm not good enough to know that. But what I do know is that we have levels that, again, you know, you can see again how we're back to this trend line. If you take this low from 2020 and you put it right through, that's what we're hammering on, right into this area. So we are into a lot of resistance. Now, there's two scenarios for the S&P. One is we stall here and we roll over, which would mirror the 1929 to 1930 period. It would mirror the dot-com period, as well as 2008, 2009. The other scenario could be the Bitcoin scenario, right? Where Bitcoin had that big middle dip and we made a slightly higher high before rolling over. And again, in both cases, there's issues for the market. One just happens to be much more overbought, which usually means the downside will be much more dramatic. What I do think, though, is that at minimum, we're going well below those October lows. And I think the two levels that I would watch closely is this pre-COVID line right here. And this is kind of like the mild recession scenario where inflation is not really that high, but we're just kind of stuck in this mild recession because the Fed can't print us out. And that would be right around this 32.65 level, right? If you get in a bigger issue, there's a secondary line here, which we can connect here, which is around that 3,100 level. So these would be the two first areas, and notice how they're converging, which means it would be major technical support in this, let's say 33 to 3,100 level on the S&P. If we want to talk about the catastrophe side of things, then you're talking about revisiting this area down here, which I hope for all of our sakes that does not happen, because if that were to happen, I would hate to see where the economy is at that point. The only reason I bring this up is that if you look at charts, there's a tendency for charts to do what we talked about earlier, which was a retrace to the scene of the crime, where you have a double top here and you break out and then you retrace down to it. Because of Fed intervention in 2009, right, and the quantitative easing that went on for so many years, the markets never were able to naturally retrace to retest that level. And the question then becomes does at some point in the future, does that have to happen? I hope it doesn't. I hope this is our kind of our base case here, but just be aware that if we got a really bad recession, let's say we get stagflation. So we get a bad recession with inflation elevated and the Fed isn't able to print us out of it. That would be potentially the target down there. Scary stuff, really.
I like comparing like this bear market to, I mean, again, I guess it remains to be seen because I know a lot of people say that it's a bull market. And I mean, from a technical perspective, higher lows, of course, it looks bullish, but we've also seen this climbing the wall of worry before and it's still resolved the downside. Look at this one compared to the 1946, 1949 one. And again, that was an interesting one because it was also during a period of high inflation, right? And that, I think, so if it followed something like that, that would actually correspond to bottoming out around that pre-COVID level of 3,400, right? Where it just goes slightly below the prior low. Another example, of course, is the 1980 to 1982. You can see that bottomed out just below where we previously went. And again, that would also correspond to around that 3,400 level as well. But again, I think the issue is what happens if it follows something like the 1970s. The 1973 to 1974, which was also coming out of a period of high inflation, right? And it's certainly impossible to know, but I think until we see the labor market start to turn, it's just going to be, because we know the market normally bottoms right before the unemployment rate peaks, because the market is forward looking. So I think that's going to be the tricky spot, is knowing exactly when the turn comes.
I agree. I think that's going to be incredibly tricky. And when it does, I mean, my guess is you'll see the first little signals, and then it'll be like all in a flush. You'll start to see these numbers turn very, very quickly, because I do think that, and I mentioned this on the spaces earlier, is that there's this tendency for employers to say, oh man, during COVID, like I couldn't get anyone to work for me. It was so hard to find a good employee. I did finally get them. I don't want to fire them. And then if it's a soft landing, I got to rehire, right? So yeah, sales are slow, revenues are down a little bit, but I don't want to get rid of them. But if you get in a scenario where all of a sudden it's a no-brainer, like, okay, we're going into a recession, things are going to be tricky for the foreseeable future, that's where that wave of selling pressure comes in. And I did have that chart up before. Let me try to bring it back up here.
Yeah.
That I just think is an interesting chart to look at. It's U.S. interest payments as a percent of GDP versus the Fed's ownership of federal debt. And look at the divergence here, right? So you have interest payments as a percentage of GDP skyrocketing, while the Fed, again, the ownership of debt is coming down. And I do think that's something we want to be aware of. It's kind of those jaws again, right? It's a divergence that at some point probably has to be remedied.
I was looking at a stock earlier, and I'm kind of curious what your view on the stock is, and it might be one that's on your watch list already. But Disney has seen a pretty big sell-off recently. I was looking at this one because it's sort of been holding. Let me switch this back over to a normal linear chart, right? We can see that Disney. This is just one of the stocks that we can look at, because I know people have talked about things related to the parks and whatnot not being as crowded. Maybe it's because of the heat. Maybe it's because of other reasons, but this is an interesting chart, because back in the .com crash, it was sort of putting in higher lows on this trend line, but then it broke down into a recession. And that breakdown was another 50% drop, right? About a 47% drop. We're kind of seeing something similar, right? Where it's sort of bouncing off of these lows. Do you think that there's maybe time for Disney to get another push higher before potentially going into that level? Is this a stock you've been looking at all? I've just been looking at it because I've seen this higher lows for a while now. I'm like, well, if the recession is here now, it wouldn't make sense, right? Because we know it could have another 50% of the downside. By the way, another 50% drop coincidentally puts it at right those. There. Yeah. So I don't, and I just, you reminded me of it when you had the S&P chart up, right? I'm just like, well, so that I think is the risk to the downside, right? Is a 50% drop. But if the recession does not materialize immediately, do you think there's potential upside in Disney?
Yeah, I mean, as a swing trade, it's actually been on my radar. There's no doubt about it. Now, again, swing trades, it's important to just mention, they're not long-term holds. They're basically holding for weeks or months or so. So I actually do. I think I look at the charts, and then I also look at the sentiment. Sentiment is really important, because we see time and time again, when sentiment is ridiculously bullish, that's when things top. When it's ridiculously bearish, that's when things bottom. So I agree with you. I think, like, if you take this low here and you just connect it right through here, you could argue that we just had a touch of that level. So the way I would trade this is that you keep a stop below, let's say, 84.50 on a daily closing basis, or you could use confirmation. But you basically can have a risk that's very limited, while if it rallies, let's say let's just look at a wedge pattern, a trend line here, right? Let's just say it comes back here to these two tops. I mean, you have upside to 106, 107. And so, again, eventually, do I think this breaks down? Yes, I do. If what's going to happen in the economy does happen, it's probably headed down. Whether it goes to 46, oh my goodness, again, that's, that would be, I couldn't even imagine the state of the global economy, let alone the domestic. But in a short-term trade, you basically risk, let's say, $3 to potentially make about $20. And that risk reward is attractive. You know, that definitely is something that I would pay attention to. Oh, I lost your audio, Ben. I'm not sure if.
Oh, sorry. They're right back. Do you think we should maybe pivot over, unlike the Fed, right? But do you think we should pivot over to precious metals? Because that was something that I know you've been quite bullish on gold and silver, I believe. And I think they've actually bounced up a little bit here over the last couple of weeks.
Yes, absolutely. In fact, but before we do that, if I could just, I want to just show quickly, because I think we have some crypto people here. I do want to give them a quick little trading level that I'm watching here on Matic. So look at the Matic chart, look at the breakdown that's occurring. Matic will have 2 levels of support. I had this as a long trade on this rally. We got out, obviously, which has been the right move. I haven't rebought even at this trend line because we've hit too many times. But you'll start to get some support around 68 cents. And then if it dumps through that, you're headed to about 58 cents, this declining trend line. But I may start, depending on how the overall charts look, there might be some nibbling that can go on. Same thing on something like Cardano here. This downsloping would be a retrace to the scene of the crime. And again, let me preface this. It's a swing trade only, meaning it's a short-term, 1 or 2 week type thing, or maybe less. But this downsloping retrace right around 27.7 cents could be a quick bounce back to this 31-cent level. And again, these aren't long-term trades. I always am nervous about talking because I think people think in generalizations like, oh, he's saying buy there, so I'll buy and forget about it for 2 years. I definitely wouldn't do that. But there are some opportunities coming up on Solana. Solana's getting close, right around $22. You'll have some interesting support there. And again, short-term trades only. But thank you for indulging me there. I just wanted to throw those charts
out. I think that's great. They probably care more about the altcoin market than precious metals.
But anyways, going back to gold here. So gold, again, we're seeing this little bit of a pullback here. We just talked about, and by the way, I like to bring this up because it's educational, is that if we just erase this line up here, remember how I just talked about the scene of the crime, right? So here we had a very clear pivot to pivot. We broke out, and then look at where it went to on a retrace to that scene of the crime before the rally. And again, this is one of the most powerful techniques that people can use if they can see the breakouts properly, is not buying on chasing when it's up here. Instead, be patient. Let it come back. Let it come back to home base or home and rebuy there. But for me, I'm continuing to be ridiculously bullish on the metals, specifically on gold.
Yeah, and it's interesting because, I mean, like, I know you said that triple tops they don't typically form as a topping pattern, right? Normally it breaks out above it. And I mean, so far, this is just a series of higher lows and higher highs ever since, about a year ago or so. So, I mean, I'm right there with you. I think that, and again, even cyclically, we saw gold rally in the second half of 2019, second half of the pre-election year. I think that we're likely going to see something like that again. One thing I'm curious about is sort of flip it back over to crypto. And because I know a lot of people like Ethereum, right? Ethereum is a really popular one to talk about. And, this is an interesting one because this is actually the week, Gareth, in 2019. This was the week where Ethereum finally started to show some weakness. It was the week of the last week of July, where it finally broke back down below its 20-week moving average and then started holding it as resistance really until early of the election year, right? And so, I mean, look, history doesn't always repeat, but it sure as hell rhymes quite a lot. And we're seeing a similar scenario play out here where, we're getting into that last week of July and Ethereum is starting to show that weakness. I mean, are you still thinking that it's likely going to fade as well? I mean, my view on ETH is that it needs to ultimately go back down to the to its regression band, right, which is all the way back down here.
Yeah. What price is that regression that you have?
So the fair value of it right now is at around 900, but the lower band is closer to around 600. So I would say, I know it sounds crazy, and like people give me a hard time about it forever, right? But I mean, like we've seen, like this is where we've historically seen the price go before the next move to all-time highs comes in, right? Like over here. Right. Yeah. We went down and then we went to new highs. We went down to it and then we went to new highs. Here, again, once we broke down to the bottom of it, that's when we went to new highs. And I know it's like I want to join the bandwagon, right? But I can't help but think, like, what if we just have to go tag this trend line before breaking back out to new highs in the next expansion phase.
Right. And I think that's super important to understand. I'm just doing some measurements here. So a couple things I want to show here on my screen is just I'm in the camp that Ethereum's going down, right? So we had this little channel. We were staying, highs, and then it would hit the low, then go to the high, then the low, then the high. And here we've broken below. So right off the bat, that's a breakdown, a technical breakdown. The target for me is this longer term trend line. And this is a short term target, but that I'm short Ethereum. And that's the target right now. So 1750, we'll call it 1740. Now you probably get a technical bounce there, but eventually we've hit on this line so many times. Eventually, I do think we break lower. Now, the one thing to kind of take into account here is if we go back to that 2017 cycle, from peak to trough, we dropped about 93% on Ethereum. So what if we do that? I mean, first of all, where are we in that retrace? So when we were at the lows, we were down 82%. If we go down to 93, I mean, hopefully this doesn't happen, but you're down to $333, and that would be the same decline. Now, granted, you probably have some more institutional money, so maybe it doesn't get there, but I think you're right on that. I mean, there's nothing that says it can't revisit 900, let alone potentially go lower.
No, I think there's been this idea that a lot of people have said that like Ethereum has outperformed Bitcoin. But I don't really think that's been the case, at least since 2022 started. I mean, this still looks like a distribution phase to me. But I went through this exercise actually, and I said, all right, well, let's suppose that I bought $100 of Bitcoin every week starting in January 1st of 2022. Had you done that, you would actually be up about 18%. Because you would have bought some of the lows, you would have bought some of the highs. It would have worked out so far. Up about 18%. Had you bought Ethereum instead, you'd be up only about 8%, right? So it does show you that the Bitcoin, which is the king, right, it has outperformed. But if you go further up the risk curve and look at, say, like a Cardano, you're down almost 30%, right? If you're just DCAing altcoins over the last year and a half, even though the market's up off the lows, you're still down, right? And that doesn't even include a lump sum. Had you lump sum back then, you'd be down like 78%, right? So, it really does go to show, and I'll just click through a couple of these, right? Like Solana, if you DCA'd, it started in January 2022, you're still down 12 to 13%. So, it really goes to show how in a bear market and in the pre-halving year, the blue chip, like the Bitcoin and Ethereum, but really Bitcoin is where you want to be. And I think that's one of the reasons that we haven't talked about it yet, right? But that's one of the reasons why we see the dominance go up a lot.
Yeah, absolutely. And I think for me, one of the things this brings back to the stock market side, which is something just to be cautious about, where money tends to flow to the safest assets. And I think we were talking about this on the spaces too. Why Bitcoin is seeing so much money flow is because in the crypto markets, it's the safest. I mean, it is what it is. But one of the things to just keep in mind that has me concerned about the stock market is this chart here, which shows the steepest rise in concentration in 60 years, right? So, you go back to the dot-com bubble and you didn't even have nearly the concentration in such few stocks. And we're talking the Apples of the world, the Microsofts, the NVIDIAs, the Googles, the Amazons. But there is such concentration here that this is a risk that if these stocks, let's just say we do enter a recession and these stocks drop 20, 30%, this will have a major impact on the overall stock market, probably as well as crypto. So it's another risk factor. And I think I love seeing stuff in chart form because it really shows you how high it was in the dot-coms. There's the financial crisis. And then look at where we are right now. That is nuts.
Yeah. Is there any scenario where a 20% correction by NVIDIA just takes the rest of the market down with it?
Yeah, I would think so. I think just the fact that it's almost become the leader in the market. Apple just kind of slowly trudges higher, but risk money is all about NVIDIA. There's no doubt about it. It's the AI, it's the hot thing. It's kind of like the sexy place to be, if you will.
What's your view on Meta? Because Meta is one of those ones that I think we both saw the value in when it was below 100.
Yeah,
I'm actually leaning in the direction I've leaned I think in this direction since it had hit about 150 or 200 that actually might be the low for Meta. Like we might not go. I think Meta will roll over and go back down into a recession. But I'm of the opinion that the next low for Meta, it could be a higher low just because of how badly Meta was hammered. If you go look at the Meta chart, like if I just pull it up really quick, just to give people an idea of just how hard it got hit, it was like 30% below the March 2020 low, like 36% below it. Like, think about what that would have to mean for Bitcoin or for Ethereum or for the S&P in general, right? Like think about how undervalued that was with respect to the rest of the market. So, I mean, I think again, we know in bear markets and recessions, assets bottom at different times, right? They don't all bottom at the same time. And, I think that there's a case to be made that this is the low for Meta, but the next sort of pull back here could just end up being, say, like a higher low. I mean, there's some gaps. I know some people like to trade these gaps. You could maybe go back to 150 or 200, but I don't know that Meta is going back below $80.
No, I'm in agreement. I actually think it probably was, and I still remember being a buyer back then. And you know how I know that I have a high probability of being right is when everyone makes fun of me. Ben, you probably feel the same way. And I still remember buying it. I think I was in a little early. I was in like around $100 and change in the low hundreds, real low hundreds. And it was like, oh, dude, I can't believe you're in this thing. It's over. Meta, Facebook is done. The all these things. That was the sentiment. And sentiment, again, is such a great predictor. And I think that, again, them diversifying into the metaverse and everything like that probably does cushion it in the future from re-seeing these lows. So I'm in agreement that I think, for the most part, I would start nibbling. I mean, depending on how things go, but the gap fills are exactly where I would look at, right? So here at 211, there might be a trading opportunity, but in terms of a longer term investment, you get down to 150. That's a significant level. You can see the sideways consolidation here right around that same level. And I do think that's a great one. The negative here is take a look at the daily chart. So the daily has actually broken down. So short term, this is likely going lower. I think for me, this is where we're headed back to. So I think we're headed back to about 246, 250, give or take. But and again, there's no doubt it was overbought. I mean, look at the tight range. It just kept going up and up in. But look at this little trend line and look at the breakdown right here. So again, my guess is short-term downside, but I agree. I doubt we see the lows on Meta again, at least not in the foreseeable future.
Yeah, I agree. I mean, I think it needs to get a correction at some point. And I drew a line, by the way, at the 100 area where you said you got it. I mean, look at it. I mean, maybe for like 1 or 2 weeks it felt bad, but I mean, look at where it is now. And I was also, I mean, I was very bullish on Meta at around that 90, 100 level, kind of open-minded to it going lower, but saying, guys, this is an extreme value because I mean, this is one of those companies that literally just prints money,
Oh yeah.
And I'm just like, I'm sitting here looking at it and thinking like, how is it 40% below its pandemic low? How does that make sense? And I think that's what you have to look for when you're looking for these undervalued assets is, where are they in reference to their pandemic low? Because if they're at that level, perhaps that's a sign that it is getting pretty undervalued. I think a lot of assets won't go to those levels. I don't think Bitcoin will go to 3K, but that it just gives you an idea of just how deeply undervalued Meta was.
Yeah, and just going back, and you just jogged my memory by saying Bitcoin 3K. So I don't think it's going to 3K too, but I do think one of what you're talking about, we were talking earlier about could it make at least a slightly lower low below 15,700? And if you think about sentiment again, where would max pain be? I mean, think about how many buyers have been lured into Bitcoin from 15.7 all the way to 31, and think about how people would feel, and kind of the talk about gut punch if you take out those lows, and that actually could create that opportunity where we look at sentiment as an indicator being so bad if we get down and we take out 15.7 or so, that it actually could be the bullish time to buy at that point.
Yeah, I mean, this is because it's interesting because you have the S&P bottom just above, right? It's like its pre-pandemic high. Bitcoin's pre-pandemic high is just below this prior low, right? Mm-hmm. So I would be curious if we do get a lower low, would it sort of find that low around 14K, 13 to 14K possibility?
Yeah, for sure. So as we kind of wrap it up, and by the way, amazing stream today, so much amazing data and information, but I do want to just go over this week because I do think this week there's a ton of important stuff. So today's kind of a quiet day. We're waiting on earnings. This is the huge earnings week. But this week we will have, so after the bell tomorrow on the stock market, you'll have Google and Microsoft reporting. Then on Wednesday, the Federal Reserve at 2 p.m. will come out and Jerome Powell will give his speech, his press conference at 2:30. The expectations right now, I think, 96% chance that the Fed hikes rates or something like that, something crazy.
98.6.
90. There you go. So basically, folks, they're gonna hike by 25 basis points at this point. The question and what the markets will react about is their guidance going forward. Are they going to say, hey, we're going to take a break for a few months? Are they going to stay hawkish? Or are they going to potentially say, hey, we think, it's their commentary that I think will be very important for the market. So just a few things to watch in the coming days that are going to be very intriguing.
One thing that I just quickly before we wrap it up, we've talked about this a little bit as well, because I think this might be the terminal rate, right? Like this could be 5.5% might be it. And the reason why that's interesting is because if you look last cycle, I've sort of thrown this idea around as well. The terminal rate is what marked the bottom for Bitcoin last cycle. What marked the 2019 high was when the cuts began. And then what marked the final low was the last cut, right? This cycle, the Fed has been so far behind the curve that the low for Bitcoin is when they pivoted from, say, 75 basis points to 50, right? So that sort of that transition from 75 to 50. And so we've talked about this idea of what if hitting the terminal rate acts as where Bitcoin's high is. And then from there, perhaps the first rate cut will be Bitcoin's final low, right? And I know I think you've said before that, when the Fed starts cutting, that's probably going to be like rocket fuel for Bitcoin, because again, once that liquidity flows back in, once we go back to QE, it's those riskiest assets that do the best.
Yeah, and I think it's important to recognize is that when you have the deficit at 32 trillion and you're seeing, the interest payments skyrocketing, and we talked about the percentage of GDP now, it's not a matter of if the Fed will ever cut rates and start printing money again. It's a matter of when. And so that's where, and I agree, once that happens, then and listen, things may be so bad in the economy, maybe stocks don't react amazingly well in that situation early on, but I do think Bitcoin starts that big move. The next bull cycle for me probably starts when they do that. And be interesting to see if that's around the halving too, right?
It tends to work out. Hopefully it works out again. I hope that we see the labor market materialize into whatever it's going to do before April of next year.
Yeah, for sure, man. All right, let's end it there, guys. Guys, go follow Ben. Go check out his YouTube. Follow him there. Twitter. Check out your service. I know you have an amazing service. You're showing us some of the data from it. So make sure to go check that stuff out, guys. Again, it's all about being informed. Be informed. Make your own decisions. I think that's what Ben and I would agree on, is that just don't live in a bubble where someone's telling you, hey, you got to buy altcoins or you got to buy stocks nonstop. Be informed.
And same, right? If you're watching this channel and you're not subscribed to Gareth, make sure you go do so. He's got his own YouTube channel. He's Gareth Soloway, but you also have another YouTube channel, right? Verified Investing as well. So make sure you guys go check that out. He's also got his own service too. So check that out. I think Gareth is one of the few level-headed minds in the space. And remember, when it comes down to everything, even, back in 2021, I believe Gareth was screaming from the rooftops, that 60, that the high 60s were an important level and that we would likely break down. And again, eventually it happened, right? I mean, it took a while, but eventually it happened, and cooler heads ultimately prevailed.
Yeah, definitely, man. So you guys have a great rest of your day. Thank you for tuning in, and we'll be back next Monday.
See you guys.